So BlackRock is out today in a story posted in Reuters saying that they have turned bearish on long-term U.S. Treasuries as AI funding wave looms. BlackRock said on Tuesday it's turning bearish on long-term Treasuries, warning a coming wave of AI-related financing could put upward pressure on U.S. borrowing costs and exacerbate worries over U.S. government indebtedness. A structurally higher cost of capital raises, they said, the cost of AI-related investment and affects the broader economy. A more leveraged system also creates vulnerabilities to shocks such as bond yield spikes tied to fiscal concerns or policy tensions between managing inflation and debt servicing costs. So I thought that was very, very interesting, given that I just was reading an article last night I'm going to share with you out of Yahoo Finance from yesterday. It turns out that BlackRock is one of the major financiers of these neo-cloud or GPU cloud companies, okay? Graphic processing units, the GPUs that are made by none other than Nvidia, okay? And we know what's happening with Nvidia's earnings. They're basically carrying right now, almost single-handedly the performance of the S&P 500. Because they can't get these chips made fast enough, they're back ordered. So interesting that BlackRock is warning about the AI indebtedness, yet they're also funding massive loans to these neo-cloud companies. So again, the story I was reading last night out of Yahoo Finance, I want to share it. Now it is front and center. And as I always humbly ask, if you guys aren't subscribed to the channel, please subscribe so we can keep growing the community and hit that bell notification so you get notified as I drop new content. So out of Yahoo Finance, listen to this. Famed short seller Jim Chanos sees risks in growing debt market backed by Nvidia's AI chips. Quote, there's going to be debt defaults. Says Nvidia's chips have fueled a new debt market, and famed short seller Jim Chanos is flagging its risks. Emerging AI cloud computing companies, neo-cloud companies, looking to rival big tech in the market for artificial intelligence have secured large loans. Listen to this, large loans backed by Nvidia's chips, using that capital to buy more AI chips to scale up their operations. The firms lease space and data centers. I would add yet to be built out data centers, yet to have electricity data centers. And they fill them with AI hardware, rent out computing power from that hardware for tech companies to train and run artificial intelligence models. 4 firms, listen to this, in the growing sector, 3 of which count Nvidia as an investor, have more than $20 billion in debt using the Nvidia AI chips or GPUs as collateral, the information reported, according to the information reported. Chanos, who is famous for predicting the fall of Enron during the dot-com bust, sees red flags in the rise of GPU-backed debt because the neo-clouds securing the loans have no clear path to profitability, making the debt hard to pay back. It says Nvidia-backed CoreWeave, which went public earlier this year, and rival cloud provider FluidStack each have roughly $10 billion in debt, using their inventory of Nvidia's GPUs as collateral, according to the information. Lambda and Crusoe are also backed by Nvidia, have $500 million and $425 million in Nvidia GPU-backed debt, respectively. Well, I should say in Nvidia chips, but those chips are collateralized for those loans of hundreds of millions of dollars. CoreWeave, by the way, reported a loss of $65 million last year. We know CoreWeave's, the stock's not been doing too well as of late. So the other big risk the article talks about, and I'll get into in a little more detail, is the AI chip-backed debt is becoming a bigger topic of debate in the tech investment world because these chips, the Nvidia GPUs, may depreciate or lose value more quickly than companies are accounting for. It says most cloud firms, including CoreWeave, anticipate their AI chips will generate revenue for roughly 6 years. But Amazon in January reduced its depreciation schedule, the useful economic life of its AI chips, to 5 years from 6 years. Chano says there's a chance that the chips could lose value even more rapidly than that, as Nvidia launches new AI products roughly every 18 months. For one, that would make it harder for companies, he says, to earn enough revenue from their chips to pay down their debt. Second, the market value of chips could fall below the value of the loans they secure, raising the risk of default. And I would say that at that point, if the market value of the chips, right now those chips folks are sitting in storage. They're not being deployed because the AI data centers are not built out yet. We've been discussing this for weeks on the channel. There are a lot of other roadblocks and impediments to these AI data centers being completed and actually becoming operational. Yeah, there's billions of dollars, hundreds of billions of dollars of deals in the pipeline, but it hasn't come to fruition. So these neo cloud companies are sitting on massive inventories of Nvidia chips. Of course, Nvidia's earnings are through the roof because they're selling them faster than they can make them. Okay, but if while they're sitting in a warehouse being stored, the market value of the chips falls below what they owe on the loans, those loans basically to Blackrock, and to the other lenders become unsecured loans. Okay, if the economic life channel says of these things, Nvidia's chips is 3 years, for example, the whole economics of a lot of deals kind of falls apart. Which is very, very interesting. So a little bit more information, some meat on the bone, and I'll wrap it up for today. Many of these loans are structured as asset-based financing, okay, where again, the borrowers, the neoclouds, are pledging their inventories of the GPUs as collateral. Lenders appear less concerned with traditional fundamentals and more with hardware value plus the near-term cash flows from AI cloud customers. And again, as a layperson, I'd like to get your input, I would question the terminology, near-term cash flows. What's the near-term cash flow going to be? There's no cash flow, as I understand, until these things are deployed in these AI data centers. I'm not saying none of them are, but they're not coming online at the pace of all these investments sitting on the sidelines waiting for approvals, waiting for electricity, et cetera, et cetera. The amount of GPU-backed debt already committed runs into the low double-digit billions, about $11 billion, according to one review. And that's spread among multiple neo-cloud firms. That's out of Business Insider. Okay, so ultimately it says investors behind many of these loans are not publicly disclosed. Okay, but you see Blackstone, PIMCO, Carlyle, and Blackrock. That tells you the lenders, who the lenders are, not which funds or LPs inside those firms were exposed. And we know to extension, those are, as I say almost on every show now, the pension funds, life insurance companies, individual wealth funds, things of that nature. Okay, and most of these deals are done, as we've discussed before, via special purpose vehicles, SPVs or SPEs. So what's the worst case scenario here? You have all these, billions of dollars of loans out there secured by these Nvidia chips sitting in warehouses in inventory not yet deployed. So what happens if a couple things go awry? Number one, borrower delays deployments, right? Chips age in the warehouse, meaning they delay deployment. How about if they get delayed? They don't control the electricity. They don't control the approval process. How about the contractors that are building these massive data centers out? Whole host of things that can go wrong. Okay, just like it does in general in the regular construction industry. Okay, so borrower delays deployments or gets delayed. Number two, Nvidia launches a more powerful, efficient generation, right? Every 18 months, right? And then the bid disappears. How about if the borrower defaults and the lender is forced to liquidate into a falling market? Well, they're going to liquidate into collateral that has less value than the value of the loan, okay? And the recovery rate ends up way below what the initial underwriting assumptions were, okay? All these lenders, including the Blackrocks, through their funds and their LPs, are putting massive amounts of money out there banking on value now. Okay, and it's not like real estate, okay, where you bank on the appreciation pursuant to a schedule. These chips are actually depreciating. I'm not seeing any situation in any of the stories I'm looking at where they're saying that the chips are going to appreciate, okay? And that's how the lenders get blindsided, to Chanos' point. Okay, I went a little bit long today. If you guys enjoy the content, leave me a like. This is insane, right? Actually, day after day after day, there's just more getting heaped on the pile. Please subscribe to the channel if you're not subscribed. Leave your thoughts and comments. Share the videos, please, with people that you think might have some value in this or get some value in this. With that being said, I will talk to all of you soon. Bye.